Imagine staring at a gray sky through a fresh, massive hole in your living room roof.
Oh, wow. Not a great start to the day.
Right. I mean, a freak windstorm just tore right through your neighborhood. There's water actively dripping onto your sofa. Debris is like scattered everywhere, and you are understandably panicking.
Completely understandable.
So you call your insurance company expecting this immediate financial rescue. But what actually happens next isn't, an instant wire transfer or a blank check.
No, definitely not. Because if insurance companies just handed out blank checks based on a frantic phone call, the entire global insurance industry would collapse in about a week.
Exactly. It's actually the beginning of a rigorous, heavily scrutinized investigation. And that's why today's deep dive is custom-tailored for those of you working your way through the Insurance Study Companion.
Such a critical topic.
It really is. Whether you're a CPCU student, an insurance professional, or just someone trying to understand this massive industry, our mission today is to completely master the concept of claims adjustment.
Which is really the ultimate bridge, if you think about it.
Right. It is the crucial link between the promise an insurance company makes on a piece of paper and the actual fulfillment of that promise in the real world. So, okay, let's unpack this.
And for anyone prepping for an exam, mastering this concept means going way beyond just, rote memorization.
We're not just reading flashcards today.
Exactly. We are going to unpack the mechanics of how claims adjustment works, why these rigid rules exist, and how a single claim ripples out to affect the entire industry. Because once you understand the underlying logic, the terminology will just naturally fall into place for you.
Let's start with a foundational definition, but let's try to strip away the corporate jargon. At its core, what is claims adjustment actually doing when that person with the hole in their roof calls in?
Stripped down, claims adjustment is a four-part action. It's the process of investigating, evaluating, negotiating, and settling a claim.
Investigating, evaluating, negotiating, settling. Okay.
Right. And what's fascinating here is that the entire goal of those four actions is to determine two definitive things. First, liability, meaning, is the insurer legally obligated to pay?
Like, is it actually covered?
Exactly.
Yeah.
And second, the payable amount, meaning exactly how much money does the contract dictate they owe? Is it covered? And how much?
So it's not just customer service dispensing money, it's an active analytical process of verifying a contract. Thinking about those actions, it almost feels like the claims adjuster has to wear two completely different hats depending on what phase they're in.
I like that analogy.
Initially, they have to be a detective, right?
Yeah.
They are securing the scene, figuring out what actually happened, checking if the physical evidence matches the policyholder's story.
Looking for any red flags that might point to fraud, yeah.
Because let's be honest, people lie.
The detective phase is crucial because people absolutely lie.
Okay.
Or, honestly, more commonly, they misremember in a way that benefits them.
It's pure human nature.
So the adjuster has to gather the raw facts, interviewing witnesses, pulling police reports, analyzing weather data for that windstorm you mentioned. They are building a factual foundation.
But once the facts are established, that detective hat comes off.
Right, and they put on the accountant hat.
The accountant hat, which is entirely focused on valuation, right?
Precisely. The adjuster is looking at the damage and calculating the literal dollars and cents.
Mm-hmm.
But they aren't just, calculating the cost to repair the roof in a vacuum.
They have to cross-reference it.
Yes, against the very specific language of that individual's insurance policy. Like, what are the limits? Are there exclusions?
Hold on, I want to challenge the tone of this for a second.
Okay, go for it.
If I'm a policyholder, I've been paying my premiums for 10 years. Now my house is ruined. I want empathy. I want help. But you're describing the adjuster as this cold, calculating hybrid of a detective and an accountant.
That's a very fair point.
Doesn't the insurance company have a duty to provide good customer service and just, take care of their customer?
Well, customer service is the baseline of how an adjuster should interact with you, right? With empathy, promptness, professionalism. But we cannot confuse customer service with contract enforcement.
Oh, interesting distinction.
An adjuster's primary function is analytical. They are legally bound by the four corners of that insurance policy. They cannot authorize a $50,000 payout just because they feel terrible for the family sleeping in a hotel.
As much as they might want to on a human level.
Exactly. They can only pay exactly what the contract dictates they must pay.
Because if they let emotion dictate the payout, they are essentially giving away money that doesn't belong to them. It belongs to the collective pool of premiums paid by everyone else.
You hit the nail on the head. They are stewards of that premium pool.
So Understanding that dynamic, the detective uncovering the facts and the accountant crunching the contractual numbers, how does this actually play out chronologically?
It's a very specific
If
sequence.
I file a claim today, what is the literal step-by-step?
Well, the industry relies on a strict 7-step chronological journey. And for those of you taking the CPCU exams, this chronology is absolutely non-negotiable.
Okay, lay it on us.
Step 1 is notice of loss. Step 2, investigation. Step 3, coverage analysis. Step 4 is damage evaluation. Step 5, negotiation. Step 6, settlement. And finally, step 7 is payment or denial.
Okay, that's a lot of steps to visualize. Let's ground this in reality so those aren't just abstract concepts. Let's look at the John's auto insurance scenario from the study guide.
Perfect example.
So John is driving to work, gets distracted, and rear-ends the car in front of him. His car is totally crumpled.
All right, so John pulls over, realizes his car is undrivable, and calls his insurance company from the side of the road. That initial frantic phone call, that is step 1, notice of loss.
So the insurer assigns an adjuster to the file. The adjuster calls John, takes his recorded statement, gets the contact info for the driver John hit, and requests the official police report.
Which brings us to step 2, investigation. The detective hat is firmly on here. The adjuster is just establishing the facts: time, location, weather conditions, and who is at fault.
Which means the adjuster hasn't even looked at the damage to the car yet.
Not at all.
They just have the facts of the event. So they take those facts and open up John's specific auto policy. They check to make sure John actually purchased collision coverage, that his policy was active on the date of the crash, and that there are no weird exclusions that would void the claim.
And that is step 3, coverage analysis. This is where they answer the first big question: is this event covered by this contract?
Let's say yes, it's covered. Now the adjuster finally goes to the auto body shop. They look at John's crumpled car, analyze the bent frame, the smashed bumper, and write up an estimate for repairs.
Let's say they calculate it'll cost $7,500.
Okay, $7,500.
That is step 4, damage evaluation. We've officially switched to the accountant hat to answer the second big question: how much?
But wait, John's mechanic at the body shop looks at the adjuster's estimate and says, wait, you didn't factor in the recalibration of the backup sensors? It's actually going to cost $8,000.
The plot thickens.
The adjuster reviews the mechanic's notes, realizes the mechanic is right, and they agree on the $8,000.
That back and forth is step 5, negotiation. And it's important to note this isn't haggling like at a flea market.
It's not like, I'll give you $5 for it.
Right. It's a professional reconciliation of differences in valuation to arrive at a reasonable cost of repair.
So now they have an agreed-upon number of $8,000. The adjuster looks back at John's policy and notes that John chose a policy with a $500 deductible.
So they do the math.
The adjuster subtracts John's $500 responsibility from the $8,000 total and officially authorizes a final amount of $7,500.
That formal authorization is step 6, settlement. It is the final agreement on the insurer's liability. And finally, issuing that $7,500 check to the body shop is step 7, payment.
Looking at this very rigid sequence, it honestly mirrors the process of a medical diagnosis.
Oh, I like that. Walk me through that.
Think about the emergency room. Step 1, notice of loss, is the patient walking in and stating their symptoms. My stomach is killing me.
Right, the initial alert.
Then steps 2 and 3, investigation and coverage analysis, are the doctors running blood tests and checking to see if this illness is actually something they can treat in this facility.
Because if you go to a dermatologist for a burst appendix, they can't help you.
Exactly. That's essentially a coverage denial. They have to verify the problem falls within their operational scope.
That makes perfect sense.
And step 4, damage evaluation, is the surgeon sizing up the required surgery. Like, how invasive is this? How much time in the OR? The negotiation and settlement phases are the doctors consulting with each other and then presenting you with the final agreed-upon treatment plan.
The reason the sequence matters so much is that a surgeon would never cut you open before confirming what is actually wrong with you. That is a perfect framework for the exams. Just like that surgeon, a claims adjuster cannot evaluate the cost of damages, and certainly cannot issue a payment before they have investigated the facts and verified that coverage exists. The sequence is the safeguard.
Here's where it gets really interesting, though. This isn't just about John getting his car fixed. Investigating a single claim requires immense resources: adjusters, software, outside experts,
It adds up fast.
who pays for all that?
Yeah, that brings us to a massive metric in the industry, LAE.
Loss adjustment expense, yes. LAE is a critical concept because it measures efficiency. It is the literal cost of doing the adjusting.
So to be clear, it is not the $7,500 paid to fix John's car.
Correct. It is the money the insurance company spends to figure out that they owe John $7,500. It includes the adjuster's salary, the cost of the software used to estimate the car parts, and if a claim goes to court, all the legal defense fees.
So if an insurance company has terrible systems and it costs them, say, $1,000 in operational overhead just to process a $500 fender bender claim, then their LAE is completely out of control. And high LAE eats directly into the company's profitability.
Let's expand on this ecosystem effect because claims data doesn't exist in a vacuum. It directly impacts pricing and underwriting, right?
Oh, absolutely. Actuaries rely entirely on the data gathered by claims adjusters to build their mathematical models for the future. This is the main feedback loop of the insurance industry.
How so?
Well, underwriters decide who to insure and actuaries decide what to charge. But they are making educated guesses about the future based on past data. If claims adjusters suddenly report a massive, 300% spike in claims for catalytic converter thefts in a specific zip code.
The actuaries immediately plug that data into their algorithm.
Yes, which means that a spike in claims today mathematically forces the premium rates up for everyone in that zip code tomorrow. Claims data is the real-world reality check on theoretical actuarial math.
Let's look at another mechanism that affects everyone's premiums, subrogation.
Ah, classic.
Going back to our auto scenario, let's change the facts. John is sitting at a red light. Another driver is texting, doesn't hit the brakes, and smashes into John.
Okay, so totally not John's fault.
Right. John's insurer pays the $7,500 to fix his car so John can get back to work. But does John's insurance company just eat that $7,500 loss?
Absolutely not. This is where the mechanism of subrogation kicks in. Subrogation is essentially the insurance company legally buying your right to sue the at-fault party.
Oh, interesting way to frame it.
When John's insurer hands in that $7,500 check, John transfers his right to recover those damages over to his insurer.
So the insurance company essentially steps into John's shoes.
Precisely. John's insurer will now go after the texting driver, or more likely that driver's insurance company, to demand reimbursement for the $7,500 they just paid out.
And why is that so important for the ecosystem?
Because if subrogation didn't exist, John's insurer would have to absorb the financial losses caused by thousands of careless third parties.
Which would bankrupt them.
Or, to survive, John's insurer would have to drastically raise premiums on everyone, including John, to cover those unfair losses. Subrogation forces the financial burden onto the party who actually caused the damage.
Which keeps the premium pool stable for the responsible drivers. That makes total sense. Now, what about the physical wreckage?
What do you mean?
Say John's car wasn't repairable. It's a total loss. The insurance company pays John the full pre-crash value of the vehicle, but that crumpled hunk of metal is still sitting in the tow yard. Who owns that?
The insurance company owns it now. And this brings us to the concept of salvage. Just because a car is a total loss doesn't mean it has zero value.
Right, the engine might still be perfect, the stereo system might be intact.
Yes, so the insurance company sells the wreck to a scrapyard or parts dealer. They recover whatever residual value they can from the damaged property.
And that money is salvage.
Exactly. And just like subrogation, recovering salvage puts money back into the company's coffers, which helps keep overall premiums lower for everyone.
Okay, we've talked about how insurers recover money, but let's talk about the dark side of the industry.
It's an important topic.
What happens when the massive financial power of an insurance company is weaponized against the policyholder? Because the power dynamic in claims adjustment is incredibly lopsided.
It is entirely lopsided. You have a massive corporation with billions of dollars and teams of lawyers on one side, and an individual who just lost their home to a fire on the other side.
That individual is vulnerable, desperate, and often financially strained.
Which introduces the concept of bad faith and unfair claims settlement practices.
Let's look at a hypothetical case study. Imagine that family loses their house in a fire. They file a claim. The insurer's internal investigation shows the claim is totally legitimate.
Okay.
But instead of paying out the $300,000 policy limit, the insurer intentionally stalls. They stop returning calls. They ask for redundant paperwork month after month.
Just dragging their feet.
Why? Because they know the family is running out of money paying for temporary housing, and they are hoping the family gets so desperate they'll accept a lowball settlement of, say, $150,000 just to survive.
That scenario is the textbook definition of acting in bad faith. It is the intentional abuse of power to avoid honoring a legitimate contract.
It's awful.
It is. And this is exactly why state regulation is so heavily involved in the claims process.
The study guide highlights the NAIC, the National Association of Insurance Commissioners, and their model laws.
Right. Almost all states have adopted some version of the Unfair Claims Settlement Practices Act. These laws explicitly outlaw tactics like intentional delays, failing to investigate promptly, or denying claims without providing a reasonable explanation.
And the penalties are severe, right?
Extremely. If a court finds an insurer acted in bad faith, they don't just order the insurer to pay the original claim. They often hit the company with massive punitive damages, sometimes treble damages, meaning 3 times the original amount.
Wow.
Yeah, it's designed to brutally disincentivize that predatory behavior.
It's a vital check and balance on the system. Now, I want to zero in on what might be the most crucial concept in the entire study guide.
Okay, let's hear it.
It's the philosophical and mathematical boundary of insurance, indemnity. And I'm going to push back on this because I think human nature fundamentally conflicts with this rule.
All right, I'm ready.
Let's say I own a 10-year-old beat-up sedan. It's worth maybe $5,000 on Kelley Blue Book. A tree falls on it, totally destroying it.
The total loss.
Right. Dealing with this is a massive headache. I don't want $5,000. It's impossible to find a reliable car for $5,000 anymore. Why can't I negotiate with the adjuster for $10,000 so I can buy a safer, slightly newer car? I've been a loyal customer for years.
Because if the adjuster gave you $10,000 for a $5,000 asset, they would be violating the principle of indemnity.
But why does that matter?
Indemnity states that the goal of insurance is to compensate you for your loss and return you to the exact financial position you were in 1 second before the tree fell. No better and no worse.
So they owe me a 10-year-old beat-up sedan. We're the cash equivalent. Nothing more.
Exactly. And it's not just about being stingy. Indemnity is the mathematical boundary that allows insurance to exist at all. Think about the actuarial math. The insurance company priced your premium based on the risk of losing a $5,000 asset. If they suddenly pay out $10,000, their math is completely broken.
And if they do that for everyone, the entire premium pool is drained instantly.
Furthermore, paying you more than the car is worth
Yeah.
creates a massive moral hazard.
Like incentivizing bad behavior.
Precisely. If insurance becomes a way to generate a profit, like if you can turn a $5,000 asset into a $10,000 payday simply by having it destroyed, it heavily incentivizes people to intentionally set their cars on fire or, leave their keys in the ignition in a bad neighborhood.
Which is fraud.
Exactly.
Yeah.
Indemnity removes the financial incentive for fraud. You get back exactly what you lost. It keeps the entire system balanced.
That is a massive perspective shift. Indemnity isn't a penalty, it's the structural integrity of the entire industry.
Beautifully said.
Well, we've covered the mechanics of the 7 steps, we've explored the macro impact on the ecosystem, and we've drilled down into the core philosophies. Let's bring this directly to the immediate goal for many of you listening: passing your CPCU or AIC exams.
Yes, let's talk exam strategy.
This material is foundational. Whether you are taking CPCU 500, 520, or 530, you will be tested on these exact mechanisms.
And this raises an important question because the exam writers know exactly where candidates get confused. There are 2 primary traps you need to be aware of.
Let's break them down. What is the first trap?
Trap number 1 is a mindset issue regarding the definition of claims adjustment. A lot of candidates walk into the exam subconsciously believing that adjustment is just a fancy synonym for payment.
They assume the process always ends with a check being cut.
Right. But in reality, a massive percentage of claims are denied or settled for significantly less than the policyholder demanded. The rigorous process of investigating, evaluating, and ultimately determining that the insurer owes nothing that is still, by definition, claims adjustment.
So do not assume adjustment equals payment.
Never. The second trap ties directly back to our medical diagnosis analogy. It's all about chronology.
The order of the steps.
Yes. The exam writers love to test if you understand the strict sequence of events. They will give you scenario questions designed to tempt you into doing damage evaluation before coverage analysis.
Meaning, the adjuster spends 3 weeks arguing with a contractor over the cost of lumber to fix a roof, only to realize later that wind damage was specifically excluded from the policy in the first place.
Which is a massive waste of loss adjustment expense. You must determine if the peril is covered before you spend a single dollar figuring out how much the damage costs.
To make sure you avoid these traps, we can distill everything into a foolproof memory tip. It's the golden formula for claims. If you memorize this flow, you will easily navigate the chronology tricks on the exam.
Let's hear it.
It goes like this. Claim filed, then investigate, then ask, is it covered? Then ask, how much damage? And finally, pay or deny.
That sequence is your anchor. Claim filed. Investigate. Is it covered? How much damage? Pay or deny. Internalize that logic, and the scenario questions become incredibly straightforward.
So, what does this all mean? Stepping back and looking at the entire picture, claims adjustment truly is the beating heart of insurance operations.
It really is.
It requires a unique professional who can comfortably navigate the friction between empathy and enforcement. They have to wear the hat of a skeptical, fact-finding detective to uncover the truth, and then seamlessly switch to the hat of a precise, contract-bound accountant to calculate the liability.
All to ensure the fair, accurate, and mathematically sound fulfillment of a promise made on a piece of paper?
It is the ultimate moment of truth. It's where abstract financial theory collides with the chaotic, messy reality of the real world. I want to thank you, our listener, for bringing such an essential topic to the table today. Understanding claims adjustment provides the necessary context for everything else you'll learn in your CPCU journey.
And before we go, I want to leave you with a final thought experiment. One that builds on our discussion about the rigid 7-step process and unfair claims settlement practices.
Okay.
I'm intrigued. We talked a lot today about the strict rules and the necessity of wearing the accountant hat. But consider the operational nightmare of a massive natural disaster. A Category 5 hurricane making landfall, or a historic wildfire leveling an entire town.
Where tens of thousands of complex claims are filed in a single afternoon.
Exactly. Whole communities are devastated. How does that immense, unprecedented pressure challenge the strict sequential process we just discussed?
That's a huge stress test on the system.
When regulators and politicians are demanding that insurers settle claims fairly and promptly to help citizens rebuild, how does an adjuster on the ground balance the unemotional rules of the contract with the urgent, desperate human empathy needed by people who have just lost absolutely everything?
That is a fascinating tension to consider as we dive deeper into the realities of the industry. Thank you so much for joining us on this deep dive. Best of luck with your studies. Keep that golden formula front of mind, and we can't wait for you to bring your next topic back so we can unpack it together. Keep learning, and we'll see you next time.